How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, on air live with the co-host of your favorite rundown show on YouTube, Vetle Forschland. How are you doing today, Vetle?
I'm great. I'm good. How are you?
Doing well. Thank you so much for asking. If this is the first time that you're tuning with us, be sure to hit that subscribe button. Vetle, I finally got ads back on YouTube. Finally.
No, that's terrible.
It's the greatest thing in the world. And here's why. I don't care so much about the money generated from it. Right. It's like nothing. But I can tell that as soon as they took ads off of my video, I just felt like engagement, views, everything. I could tell it just went downhill.
Because now YouTube has the incentive to promote you guys now.
Exactly.
Wow.
Exactly. So I'm happy about that. We had to verify. They had to send me a pin to verify something, my address basically with the YouTube account, and it took forever, but finally got it back. So I'm very happy to have that and, be able to monetize, but really just because I feel like I said, they just push out the content more. So a lot of things have happened, Vetle, in the past couple of days. What's today? Today's Wednesday. We're recording this. Snowflake IPO. You want to talk about this? Berkshire Hathaway and Salesforce are going to invest in the company. One thing that I thought was very interesting, I was looking at their S1. It's the third page down they put out there that says each of Salesforce Ventures LLC and Berkshire Hathaway Inc. have entered into an agreement with us, pursuant to which they have each agreed to purchase $250 million worth of our Class A common stock in a private placement at a per share price equal to the initial public offering price. I thought that was funny that they, included that right at the beginning so people could see. I think they're trying to, they are going to raise, is it $2.7 billion is what they're going to come public at?
I don't know. I know the valuation they're looking for is about $20 billion. So, but I'm not sure how much they're raising.
Got it. So have you ever heard of this company?
I've heard about it briefly because it's like a really high unicorn. I believe it's one of the largest unicorns, in the United States. At least they weren't public. So now they're going public. So I had briefly heard about them. Didn't know too much about them.
They do data and stuff like that. Obviously their growth is just crazy. I'm looking at their Q3 2019 growth. It looks like they did 29 million in revenue. And
I think they grew sales by 150% or something insane. And they're guiding, the same growth rate going forward over the next couple of quarters. So it's growing massively. And I kind of know a tiny bit about it because I read up on it. And what I do know is that apparently this is one of the few software as a service companies that offer a hybrid database, so you can use both Amazon Web Services and the Microsoft what's that called, the Microsoft
Teams.
No, the Azure one, the cloud
Azure
software.
Sure.
Azure, So this is the only hybrid database apparently that can use both of them. So if you have Snowflake, you can choose between using either at the Amazon cloud storage base or the Microsoft one. So I guess that's the game-changing part about this company. I'm not sure what their long-term competitive advantage is, but apparently this is a unique company.
Yeah, definitely, and it's very much unique that Berkshire Hathaway is going to invest in it. Ted or Todd, again, seems like they've been very active, and whenever they do something that's outside of Berkshire's normal investing, obviously a lot of people always it's always newsworthy because of that. And I think if anything, it really just shows, that Berkshire is going to be different going forward. And I think we all know that. But again, here's the thing that's fascinating is, the different size of the portfolio that Ted and Todd is managing compared to Berkshire or compared to Warren Buffett, and how they're able to do maybe one-off deals that are more interesting than, what people would expect Warren to invest in, buy more Bank of America, stuff like that. So again, it's just the capacity, with different levels of AUM, you're just so capacity constrained in what you can invest in, which only, in my opinion too, just shows how great Buffett has, done over the years, because he's compounded at a great rate, while his assets have just absolutely soared, but I thought it was, pretty interesting to see this come across. It seems like a great business, quite honestly.
Yeah. I mean, I totally agree with you with what you said about how Ted and Todd is, making bigger moves than we're used to. And I think that on that subject, I think that we'll probably look back on 2020 and kind of look at this year as a turning point when Berkshire finally became like an investment company independent from Munger and Buffett. Because if you look at the trades that gather the most media coverage this year, it's been, probably Ted and Todd trades. So there's the Snowflake IPO and buying Barrick Gold. I'm guessing that was Ted or Todd because the dollar amount was so small, and it's also not very Buffett-y to buy a gold miner.
Mm-hmm.
So Ted and Todd are really making big moves.
Why do you think this is like so Ted and Todd have been with them for how many years now? At least more than 5 years, maybe. I'm surprised why we're starting to hear about this now. We haven't really heard about too many other like very interesting, and maybe it's just 2020. Things are, you had a sell off in the market, and I don't know, but I thought that was fascinating. It's an interesting company to look through. I was reading the S1 in preparation for this, and I was like, wow, this is pretty interesting.
It's a solid company. I mean, I have a friend who has some friends that told my friend that work in IT, and they say that like everybody wants to work for Snowflake. This is like the hottest company on the street. And people are saying that they're going to eat Oracle's lunch and eat SAP's lunch. So apparently this is one of the hottest IPOs since like Lyft or Uber or even Facebook. And so that makes it even more interesting that this is what Berkshire decides to invest in as an IPO.
Yeah, and they'll probably be more profitable long term than Lyft or Uber, which is,
of course. I mean, software as a service businesses are amazing.
Yeah.
They're losing money now, but they'll probably make a ton of money once they're a mature company.
Yeah, they just gotta turn that,
just gotta
a little bit back.
The money machine back on.
Okay, so this news was crazy yesterday. Nikola and General Motors, they announced a strategic partnership.
Oh my God, yeah.
There's a bunch of different things that's involved here. I could go over the key terms. General Motors will receive 11% ownership stake, which is 47.7 million shares, in Nikola in exchange for in-kind services. Let's see. The new shares will be subject to a staged lockup provision beginning in 1 year and ending in June 2025. General Motors will engineer, manufacture the batteries that Nikola's trucks are going to use. There's a lot of other stuff as well.
Yeah.
Let's see. So I was reading. So they entered into a master electric truck development agreement for the design and development of certain electric and fuel center power trucks that are to be identified under individual program plans to be entered into by the parties, each of which will have a default term of 6 years. Let's see. Under this agreement, I'm kind of skipping through. I just copied and pasted things that I thought would be interesting to talk about. The company, so Nikola, will reimburse GM for up to $700 million of capital expenses to make available manufacturing capacity for up to 50,000 units per year of the initial 2 vehicles.
I think it's a great deal for Nikola shareholders. I mean, Nikola really doesn't have anything to show for a value. They basically just have a blueprint.
Yeah, they haven't sold one truck.
They haven't sold one truck. They haven't even built a truck. They don't even have a factory. Like, at least Tesla has a factory. They're building company. Now they're building cars. People love their cars. They're making money on some of their cars. Nikola has nothing. They have like a drawing of a hydrogen truck or something. And then they got Trevor Milton is walking around and showing this piece of paper to everyone.
Could this be career ending for Mary Barra if this doesn't work out?
I mean, it's a pretty big investment, $2 billion. What's the market cap of GM?
I don't even know. It's gonna be
what did it make last year? Yeah, $2 billion is not. That's a fair amount of money.
Let's see, $46 billion market cap.
So 4% of GM's market cap is in Nikola, basically.
Yeah, so the stock was up. Nikola was up 40% yesterday or something crazy. Here's something funny. So I flew on an airplane. So I went back to Illinois for Labor Day weekend to visit family. And I was sitting next to a guy. It's not like I was looking. I just happened to notice. 10 times throughout the flight, he was checking Nikola and GM. And this was I think it was last Friday. So before the news came out, he just kept checking those two prices. I swear, 10 times.
Oh, really?
Throughout the flight.
GM, wait, before the news broke?
Yeah, he just kept checking. And I mean, I didn't think anything of it other than, wow, this guy, likes electric vehicles, probably.
Yeah.
But he kept checking.
So he made a killing.
I guess he did. Yeah, I wonder what he knew. I should have asked him, right?
You should have asked him, like, what do you... Yeah, maybe he was an inside trader or something. Where were you? Were in Chicago?
Yeah, I was going to Chicago.
Right. I don't know. Maybe you were sitting next to Trevor Milton. Who knows?
Yeah, I actually... So here's something funny. I was listening to the interview between him and General Motors CEO. And... Andrew Ross Sorkin was talking about the valuation of the company and asking Trevor what his thoughts were. And he's like, look, people reward, what's going to be very impactful in the future. Even though that they don't have anything, even in process of selling and stuff. I don't even think, the company literally started trading in June. Not even 6 months ago, Vetle.
Right.
June.
Yeah. It's June. That's incredible. But yeah, that's true. It started trading in June, but this was a SPAC, right?
They did like a reverse merger, so yeah, it was something along those lines. Yeah. So I don't know. It's crazy. I mean, our electric vehicles, it's almost like this is the new craze, right? I mean, you should just register a company. Vetle and Andrew's EV company will come up with an elaborate plan, a beautiful presentation, and we could just go raise billions of dollars.
We just need to find out what Nikola's Tesla's middle name was.
That's right. Yes, exactly. That's exactly it. That is exactly it.
But you know what? I had a tweet this other day about how I'm sick, how I believe the ESG bubble is like comparable or maybe even worse than the internet bubble, the stocks listed in Oslo, because in Europe we were having this ginormous ESG bubble, and especially in Oslo, like investors are buying up everything that even mentions ESG in their investor presentation. And in Oslo we have like an IPO every other week, and it's like they're always oversubscribed. And they're offering some innovative, reason for why they will save the world through something, ESG something. And it's just incredible to watch, because I believe we have this company called Quantifuel in Norway, and it was up 25% today for no reason. And it's valued at like 10 billion kroner. And they don't have a product. They have nothing to show for. But they have this promise that they might turn plastic into oil. And that's their investment strategy, and investors love it. And we got like a bunch of those stories over in Oslo. And I think that the reason for why we have such a big ESG bubble is because capital allocators and funds, they need to have some ESG companies in their portfolios because of new European laws that will trigger next year. And if they start bringing in those laws into the United States, then we'll see a similar ESG bubble. So I think there's a risk, or that there's a big chance that the ESG bubble we're seeing in Europe is going to move over to the United States by 2021, and we're already seeing signs of a bubble within the niche of electric vehicles, which I think is incredible and a big sign of the times.
Yeah. No, I would agree with that. Speaking about electric vehicles, so Tesla got denied from the S&P 500. I think that news came out last Friday. And I think news came out Tuesday, that they already, sold off the $5 billion at the market offering that they, announced the previous week. So there's a lot of bag holders. I mean, I think the stock's down like 30% or 40%, something crazy.
It's up like 8% today, but it's down a lot.
Yeah. Any thoughts on that? Like, what about the S&P 500? Not being added to the S&P 500.
It kind of seems like, well, first of all, the only dumb thing Tesla did do was that they didn't raise more money. That's the only dumb thing they did.
I was kind of surprised. I mean, I was talking to somebody about this, and I was like, I would do the same thing. I mean, they need, obviously they need capital, and the stock prices.
I mean, this is like a great move from Elon Musk.
Yeah,
this is like buying back. This is like buying back. This is like basically kind of the opposite, or this is basically like buying back stock at dirt cheap prices.
Are you surprised that he only did $5 billion?
I think that's the only amount he could do without spooking the markets.
Yeah, I wonder.
Spook the markets.
I was gonna say, I wonder if like they chose $5 billion because it would just be viewed as like nothing, and then that happened.
It would have been too obvious if they raised like 10 or like 50 billion or something like that. even though they should have. But 50 billion is a lot of money, and it's difficult to find 50 billion of institutional investors because you need buyers for the offering, and you need buyers, and it's not easy to find buyers.
Well, if I remember right, the stock actually was up on the news the day after. And then obviously just yesterday it was just getting smoked and into the end of last week. But I think it's part of it because a lot of people were betting on the S&P 500, inclusion of Tesla, and then you're going to have all these index funds investing in Tesla and everything like that. So like the natural inflows that you'll have. So a lot of people were betting on that. And it's just, if anything, it shows how volatile some companies can be. And there was John Huber, he usually, I think like once a year, he'll like post an Excel, and everybody listening could do this. And basically, I think the way he does it's like the 52-week low and the 52-week high to show how much even very large companies move within a year. And it's a pretty big amount, it'll be like, I think north of 30%. So it's crazy. Tesla's such a story in 2020. And we'll see what happens.
Yeah, and exactly. And I've seen that chart or that Excel sheet from John Huber, and it's not just Tesla. This happens to big companies all the time.
Very large companies.
and not just in 2020. Like obviously, you could have bought Apple at I don't know what that Apple. You could have bought Apple and this huge company, and every single company at dirt cheap prices in March. But usually, every single year, there is a major correction in one of the stocks on your watch list. So there are plenty of opportunities that arise every single year without a correction.
Yeah, which is why it's so important to continue building that watch list, right?
Right. Yeah.
And I was talking about that. We've talked about on the podcast before. The work to do on companies is when markets are at all-time highs. Now the pandemic was a little bit different, but if you weren't having to do like the initial however long it takes you to do due diligence on companies for the pandemic, you were just that much ahead because when we had just stupid cheap company or prices for some of these companies, you would have been able to act, quite decisively. Now, of course, with the pandemic, it was probably a little bit more than that because you had to make sure that business is going to be able to, survive and be around and stuff. But, if anything, you can make a lot of money on the volatility that goes, within these companies. So it's just important to build a watch list. I mean, is that how your process is typically, or how do you typically go about that?
I do research companies regardless of the price. I mean, the price is basically just like a nice cherry on my sundae. If I can find a great company, or if I can find something that looks super cheap, then that's a plus, obviously. But sometimes you just have to research the great companies, and you'll have to wait for the price to come down to you. So I think or
just watch it go up for the next 5 years and be like, no, it's gonna be cheap. It's gonna be, I'm waiting for a pullback. It's up like
exactly 100%. That's what usually happens.
But do you build do you have a watch list you typically follow? How do you really go about that? I mean, you've worked at fund, so I'm just kind of curious. Maybe people could take away different ways of going about it.
So basically, I research companies all the time, and I keep a huge watch list of all the companies that I think I know fairly well, and I follow these companies and I keep up to date on them, and I kind of know what the investment case is, and then I have not necessarily, often I have it written down, but not necessarily, but I have a certain price where I would like to buy it, or I have a problem with the stock that I'd like to see fixed, or if it's a turnaround case, then some signs that they're actually going to turn around. There are certain companies where there are big structural problems with the company, like they're not making a lot of money, or their margins are getting hammered and the stock is getting hammered. So if you keep it on a watch list, and if you watch the investment case, or if you watch the investment story evolve over time, as soon as you're seeing signs that we are close to a recovery, then the stock price is going to react upwards by maybe 10 or 20%. But if the stock is hammered enough, then that might not matter. So what I'm trying to say is that sometimes you'll watch a company that is struggling a lot, and if it's a turnaround case, then then you, instead of trying to catch a falling knife, you'd rather want to see the fundamentals improve, and then you can buy into the stock. And that's something that we did a lot at the fund I worked at this summer. That's a new strategy they started implementing, and I think that's a decent strategy, right? So I know that you guys keep a big watch list as well, and I think that's how I basically research companies, is just by collecting and knowing as many names as possible, keeping them on a list, kind of knowing the story of each one and following them as they evolve along. And sometimes I'll start researching stock and it's going to be an obvious buy. Sometimes I'll put in a research on my watch list, and then sometimes some of the names on the watch list is going to drop a lot one day, and it's going to be like an obvious buy or something. Like, for instance, Match.com. I think the day, not that it's been on my watch list or anything, but the day that Facebook announced that they were going into online dating, Match.com fell like 25% on one day. And, nothing fundamentally changed about the Match.com story. They still had their same customers. People still use Tinder. Nothing happened to the fundamentals.
From personal experience?
With Match.com?
With Tinder?
No. Yes. I didn't. Yeah, it's not like I uninstalled Tinder when I saw Facebook was announcing your competitor. It's not like it. So
it's good.
Yeah,
that's good scuttlebutt. So what else? Keep going.
It is. No. What I was going to say was that that was a great opportunity to buy into a great company. Unfortunately, I only read about this, after the fact. But if you would have had Match.com on your watch list, that would have been an excellent time to buy in. Because if you look at the long-term chart, it's gone, up since its IPO, except for that one blip on the radar.
Yeah.
And people bought the dip, and it was back to all-time high, weeks afterwards. And I think that there's a fair chance that those opportunities are going to arise if you keep a decent watch list. And as long as the watch list doesn't grow out of proportions, so that you don't really know what names are on your list, then I think that's a good way to work. What do you think?
Yeah, no, I think that's great. Do you use screens? And I'll tell you my process, what I've been doing in a second. But do you use screens?
I have screened, but I don't use screens regularly. No.
Yeah, the only reason, screens are, in my opinion, kind of overrated in the way that I think some people think to use them. The way I do it is literally it's like gross profits to net tangible assets, something along those that criteria. And then really what I do is if it, spits out 500 companies or whatever, really I'll go through and I'll read the business description of each business to really see if it's something that I think we would be interested in just based on the industry. I don't really take into account valuation, any of that stuff. I just kind of look at it as I'll go to QuickFS and, type it in, read the business description, kind of get a little bit of a snapshot. And then if I think it's an industry that we could be interested in, just from, all the companies that we've looked at in the past, I'll put that on a list or whatever. And then from there, I really try to go one by one and then really do a little bit more of a deeper dive. There's some companies on my watch list that I know, the story, really great. And then there's other companies that I don't, but I think, well, it could be interesting in the future at a certain price because I like the actual industry or I like the business itself, and I think that's generally the right way to go about doing it. And if the screen we use, like I said, is gross profits to net tangible assets and the turns of that. I think that's a good place to start. And then of course, if you have a market capitalization on it, let's say you want to look at companies that are, less than, I don't know, $1 billion or 300 million or 500 million, whatever that number is, that's typically where I start. But then I just go through one by one and just kind of, I'm not turning any pages. I'm just scrolling the mouse and, reading the business descriptions and going through and see if it's something that I think we could potentially be interested in. And then, from there, it's just really doing, more research. I'm kind of curious because I was talking to someone the other day. He was telling me he feels like he gets research ADD is what he calls it. So
research what?
Research ADD, just he'll start researching a company and then, doesn't go too deep on it. And then he'll go research another company and blah, blah, blah.
I definitely have that too.
Yeah. Sometimes companies just kind of jump out at you, but you really have to look at a bunch. And we've talked about this, Geoff and I how many companies do you think you have to look at? And let's say you don't look at, them that hard, or maybe look at other companies harder than, other ones. How many companies do you think you look at before you're like, wait, this is actually kind of interesting, I want to,
Before it's kind of interesting, or before,
before you think it could actually be a position in your portfolio?
It's difficult to quantify, because for a lot of them, you're just kind of glancing at it and you're passing on it, or you see something and you're passing on it. But I don't know. So I haven't really done the numbers on that, so I wouldn't know.
If you had
maybe I don't know, 50 or 50 maybe. I don't know.
I think Geoff and I, we were talking about, we said 100.
100, yeah,
probably 100. Yeah, I mean, I may think companies are interesting, but like to actually go in the portfolio, it actually probably could be even more than 100. It's a lot, Yeah, it's a lot.
I think I don't remember who that was, but I just read about some fund this weekend that said that they go through about 200 names, and then they find 3 or 4 names to invest in every single year. So that's 1 in 100 or 1 in 50.
Yeah,
I don't remember who that was. It's a big one. Speaking of, oh wow, I just remembered. I just got Market Wizards in my mail today. I just forgot it. But I think Market Wizards just arrived, the books.
Yeah,
I think I ordered them.
The old one?
The hedge fund one and the original.
Yes,
I've never read them.
Oh, you've never read? They're good. The first one's more trader based. It's more like guys trading in the pits.
Yeah, it's like George
and options and stuff. Yeah, but it is awesome, dude. You're gonna love it.
I know the hedge fund one has like Jamie May and Charlie Ludley or whatever, the guy from
Joel
the Big Short.
Greenblatt's in there.
Joel Greenblatt, Ray Dalio, right?
I think so. Yeah.
Joel Greenblatt. That's cool.
Yeah,
I'm looking forward to reading that.
You'll like that book. So that's so funny you say that, because I just
remembered it's in my.
I was just on Amazon like, I don't know, an hour ago, and I saw that he's coming out with a new book November 3rd. I know. It's called like Unknown Market Wizards or something like that.
I think it's like Twitter traders or something.
Yeah. I love the I really do love the series, and obviously we're not traders, but it is fun to read about them.
Very fun. Yeah. And I think I think Geoff talked about that as well. Like if he would ever write a book, it would just be case-based. And this is kind of case-based, right? It's like, I've read some summaries of the book, and it looks at the cases that different investors did during their career.
Yeah.
So I feel like there's a lot to learn from that, instead of, it gets old to read some investor talking about his philosophy. Instead you want to read how he implements that philosophy, right?
Yeah. A lot of the first book you're going to read is a different way of trading that I just don't think exists today. Some of them were market makers. Like I said, some of them were in the pits, trading futures and stuff. So I'm from Illinois, and I had an internship at Thinkorswim, which is owned by TD Ameritrade, which I guess is now owned by Schwab. But in the Chicago office of Thinkorswim, which is TD Ameritrade's like trading platform, but they were also a brokerage firm as well. Everyone in that office was like old floor traders, and from back in the day, and they would all trade throughout the day. It was just like fascinating to see.
Wow.
But they all said as soon as things went electronically, it got harder. The bid and ask spread tightened. It became much more like a Citadel like market, and it was harder for them. But no, you'll definitely like that first book. I always said if I was born earlier in life, I think I would have found my way to the CBOE and the options, the pits and stuff like that. Yeah.
It looks a lot of fun. I'm kind of sad that whole way of living is extinct.
Yeah, I used to remember the signs because we took like a field trip for the interns one day, and we went down to the pits and stuff, and there was probably like 20 people in there. And
wow,
even 10 years ago, it was, 10 years prior to that, it was more packed. So it's just, everything's electronic now. I have an uncle, a cousin that I've actually never met, but people in my family talk about him. Who I think he dropped out of high school, and this was probably in like the 80s or 70s, 80s, and he traded on the pits, or in the pits, and his whole career was very successful. I think his trading account was like 10 million, And as soon as, everything started to go electronic, he just quit. He doesn't even trade anymore. He doesn't do, he started investing in bars and stuff like that. He totally left the business.
Huh. He's alive though, right?
He is. Yeah.
Yeah. You should meet him. You should just talk stocks with him.
Crazy. But it was such a different world back then. A lot of the guys I knew they traded in was called the OEX pit, which was basically like the S&P 500. But they would say that you could feel the order flow of the market just based on how crazy people were going in the pit and stuff like that, So it was just a different world.
Right. Yeah.
Cool. Well, make sure you let us all know what you think of that book. I've listened to it a couple of times. I love it. I think it's such a cool book. I think Paul...
The audio version?
Yeah, on Audible. I have the actual hardcover and the Audible version. I think Paul Tudor Jones is in that book. I want to say they write.
Probably.
Yeah. And have you ever seen that movie that's about...
I've met it 2 times, actually.
That like every now and then pops up on YouTube, but then gets taken down a couple months later.
Yeah. I mean,
I don't know why he pays to get it taken down. I mean, it's like, dude,
it's a good story.
Yeah, he's a passionate guy. I think because he thinks he looks weird or something like that, Yeah,
and I guess it comes across that, he's kind of conceited in the movie. It's kind of like an asshole, but I mean, it even shows. And he has like this huge villa, and he rides on his horses, etc. And he also predicted like the '87 crash by just drawing a chart that. Maybe he's not proud of the way he predicted that crash, even though he was right. Yeah. But I never understood why he hates that movie so much, because it even shows him going, giving to charity and having this kids that he's kind of tutoring about life, etc. So I don't know why, but I read the stories, and I think that the second the DVDs came out, he just bought up everything, and I guess he burned them in his backyard or something, but. So I'm not sure how it comes how it ends up on YouTube every once in a while, but it does, and it's probably there. And I think everybody should watch it. It's a good historic piece on the way trading was back then.
I just wonder, at what point did he realize he absolutely hates it? Is it when he was watching it before they were going to release it, and he's like, "No, you absolutely can't do this."
Yeah,
it's funny. So I was reading King Icon by Mark Stevens, and I've read the book before, but I've talked about a few times on the podcast. I'm rereading books I read 3 years ago, 4 years ago. And it's a very interesting experience to do because you take away a lot more from it because, you get more experience with other situations, you learn and stuff like that. So I always, suggest people to do that. But anyways, I was listening to a podcast where they were talking with Mark Stevens, the author of the book, and he was going through how he wrote the book and how it came to be. And he said that he lived in the same town as Carl, was in Bedford, New Jersey, and which is, I don't think, far at all from where Geoff grew up. Geoff grew up in Bedminster. And if I'm not getting them confused, I think it's Bedminster. And he happened to come across, Carl Icahn one day, and they just started talking. And he told him that he was an author, and he wanted to hang out with him or something. And Carl invited him to play tennis at midnight, which was interesting. You learned in the book that Carl likes to sleep during the day. Apparently, I don't know if that's still true.
Okay, that's also like Geoff.
It is like Geoff. I was like, I thought of Geoff. So, and I was like, this is actually a pretty interesting negotiating tactic. So if you're going to sleep throughout the day, you set a meeting to negotiate with the CEO or whatever at 6 p.m. and you wake up at 4 p.m. You just feel amazing. Imagine working all day and then having to go, have a meeting and negotiations and stuff like that. So he strategically likes to schedule them at 6 p.m. because most people work, 9 to 5 or whatever throughout the normal day. And he'll be sleeping and then wake up at 4 p.m. and then go negotiate,
Yeah.
So anyways, he invites Mark Stevens over and they start playing tennis. They play tennis at midnight. So I guess Carl was he was sort of flipped. And eventually he told him that he wanted to write a book about Carl. Carl said, absolutely not. I'm going to sue you if you do that. They went back and forth for a while. Mark Stevens said, there is a First Amendment that, freedom of speech. I can write a book. I'm going to write a book about you. And then I guess Carl said, okay, well, we'll be partners with this going into it and we'll split the earnings from the book 50-50. Mark Stevens agreed to it. I guess then Carl the next day sent him a 30-page contract going over this, And Mark Stevens said he got the contract and he was like, if I go into business with Carl and he has control over this, like this is just never going to get out there. It's never going to get out there. So he basically told Carl that he's not going to partner with him on this, but he's still going to write a book. And I guess Carl was pissed off because he's like, I spent $50,000. You know, the guy he was worth like $1.2 billion at the time. He's like, I just spent $50,000 to have this, drawn up or whatever. But he knew if he were to go into, a partnership with him, that the book would never get released. So I just find that interesting. I guess that's a long way from when we're talking about Paul Tudor Jones or whatever, but how he didn't want to have the book released or the documentary released. He's done everything he can, even in 2020, how many years later to continue to, not make that DVD get out there. So I just think it's kind of funny.
Yeah, it's hilarious. It's a lot of fun.
It's odd. So make sure you check out that book as well. You'll like that. It talks about his experience with TWA and Texaco and, other battles he's had throughout his career. So it was
I've been wanting to read some biographies on him, actually. So
there's actually not a lot on the internet about him, which is fascinating in a way. He has a couple lectures that he's given, and you could find like old newspaper clips and stuff like that. But not a lot into,
and there's
like,
the
his personal life and
CNBC
stuff.
debate with Ackman.
That too, of course. Yeah. Like that's more modern, but other than that, there really isn't a lot. So I thought it was interesting rereading that book, and I definitely suggest that to everybody as well. Well, this is going long. This was great, Vetle. We talked about a bunch of different topics. Thank you so much to everybody for tuning in. Make sure you check out Market Wizards. Vetle, you have to let us know your thoughts on it. I mean, you're not going to become a better investor from it, but you will.
Really?
There's something you can take away from everybody, I mean, the psychology of investing. Traders are very big on the psychology of investing and how to think about it.
And I'm looking more forward to the hedge fund wizards one, which is more about investors.
Yeah.
The first one is more like for entertainment.
Yeah, it was just a different world back then too, So it's cool, and you'll enjoy reading. Well, thank everybody so much for tuning in with Vetle and I on the rundown. Make sure you hit that subscribe button. Check out Vetle's Twitter, Vetle Forschland. I have his @ in the About section. Vetle, thank you so much for tuning in, and we will see everybody in the next rundown.